Hi, everyone. It's Grant Abbott speaking, and welcome to this session. We're going to look at property, and I want to do a deep dive on property. Sorry about the date on this wrong, but I want to do a deep dive on property, have a look at various structures, strategies. I want to look at protection, insights, tax, SMSFs, trust, hybrids, discretionary trust, testamentary trust. So there's a lot of stuff that I plan on going through today, and also showing you exactly what the best structure is to set up virtually any business, or certainly any property or property development. And there's certainly, from my perspective, there's been a lot of thinking going on this over the last probably 2 or 3 years, and really it's coming to the fore as I'm drafting more and more documents, our testamentary trust, our hybrid trust. I've got I did an employee share plan for I Love Accounting the other day, which I think was brilliant. So the more I get into drafting, the more strategies I see, the more opportunities I also see. So I think there's certainly a lot of opportunity there for us going down the track. One of the ones there, obviously, from our perspective, is in terms of the business. You may or may not have heard, we've won the Startup of the Year under the Australian Digital Technology Awards, and was 6 overall in wealth and SMSFs. We're going through a bit of a capital raising at the moment, so everything's good. So we're actually been oversubscribed. So that's a fantastic result. From our perspective, we're cash flow positive, but when we're the technology that we've got at the moment just isn't strong enough for modern day. And essentially what we've got is 2 servers that are talking to each other. So one has the Hot Docs platform, which is the platform that Abbott-Family uses. And then we've got the Lightyear Docs, which pulls the information or overlays that, does the vault, produces all the documents, makes relevant charges, etc. When we did that 2 or 3 years ago, that was my choice. And probably looking back, look, you just don't know what you don't know. Google has made some quite significant changes to their cookies in relation to what they call same site. So it's one website with 2 or 3 servers. And that sort of had some deleterious impact in terms of invalid sessions. But we're getting over that now. Firefox works well for me, as it does for many of you. And we're well on the track to get that LYD 2.0 up. So I understand it's very, very close. Importantly, for that perspective, that's going to allow us to do so many more things because of the ease of the integrations, and with that Lightyear Docs 2. Because it's not using that same site formula, we're not going to have a problem whether it's Chrome or whether it's Firefox, Brave, or alternatively Microsoft Edge. So that's on its way down the track, and you're going to notice a completely different look and feel. So I'm really excited about it, but we'll still have at the back end, which I think is the most important, that whole range of documents. So we've got unit holders agreements, shareholders agreements, the hybrid trust to go up, the new testamentary trust, the living trust, which is the next level on from the family protection trust coming out. We've got a family protection company for bucket companies. So we've thought through a whole lot of processes, and at the end of the day, you're going to find that the moat and the castle, for those of you using it, will actually get expanded even further. We're lucky with the capacity. Our last moat and castle, unfortunately, blew up when I tried to put advanced healthcare directives in there. It was just too much for it. So with our new one, I've been assured that that's not the case. So we'll be able to do everything for couples and families, all in that one interview, which obviously saves huge amounts of time. Increases the viability of the charges you're making when you can virtually do everything for them. But more importantly, there'll be a lot of integration. So push-pulls through BGL, Class, XPM, ASIC, ABN, TFN, also My Prosperity. So there's going to be a lot of stuff there. So I'm pretty excited. I just wanted to let you know where we're at on that one. So it's definitely 100% better than what we've got. So if we got, we've made, I think it was an old saying, my wife doesn't understand it when I say it, but we've made a silk purse out of a sow's ear. and that's definitely the case. So we've done extremely well, and we're well on track to really start to kick some goals. We've been very lucky. We've picked up a lot of people from Now Infinity and other platforms who don't receive any technical legal support and certainly no CPD. So by having that one-stop shop, it's fantastic. And with our partners, we've got a lot as well. But again, for those of you who really want to take it to the next level, invest in yourself and your business, I'd highly implore you to come along to that Succession, Asset Protection, Estate Planning Advisor accreditation. We've got around about 40 people going at the moment. I'd like to, it doesn't matter, 40, 20, 13 is good. I'll be in Adelaide shooting it with my brother. So we'll be going live. I'll have the proverbial whiteboard there. So we're really going to get down into it. We'll be looking at a lot of legislation, a lot of rulings, everything that sort of goes on here. We'll be breaking it down to the nth degree. Part of the standards from SMSFs as an advisor, and out of this you'll have a position that will be accredited, and then we just need to be certified through SMSFs, which is simply an examination which we'll be doing on the last day anyway. So that's a very, very exciting opportunity to be one of the first in that space, and certainly we can see there's a huge amount of volume there. When you think in Australia, and we're going to go through the Protector a little bit later on, how many Australians are sitting on homes that are worth more than say $600,000, $700,000, $800,000. In some instances, if you look in Melbourne, Sydney, Gold Coast, even up here in Sunshine Coast, potentially you've got homes that in the multi-million dollars. Even saw in Adelaide the other day, there was a home in St. Peter's, which is a lovely suburb, but that's gone for 7 figures, and that's just unheard of in Adelaide. So the property market is booming, but it's all very well, as we'll see a little bit later on, that leaves all your clients exposed. So whereas my one real passion to start off with, was tax, then I moved to self-managed super funds, and look, I shouldn't say they're a dying cause, but they're perfect, but there are limitations on what we can do. And at the end of the day, when you have a look, there's around about 27, 28 million superannuation accounts in Australia, and there's only a million or about 1.1 million SMSF members. So it's definitely not for everyone. However, the structures around succession, asset protection, estate planning absolutely is for everyone. When you have a look at the Miller and Taylor case, where a $600,000 estate effectively took 5 years to settle with legal fees of more than $530,000, it's certainly the way forward for you. So that if we have a look here, I think it's pretty good. Let me just take this down. So, from our perspective, I've got this little graph where really, and particularly out of that course, you're going to get a lot of confidence. And that's essentially what I find when I deal with many of you on the phone, is that you understand the right things, but you just lack that confidence. Doing the course will give you that confidence. Doing the accreditation will even give you further confidence, because you've made your mark there. But more importantly, right at the front end, and as you can see there from that arrow down the bottom going from left to right, it's the early adopters and the innovators who really make all the high income and all the fees. And by the stage, we get down later on down the track to the late majority of the laggards, it tends to be commodity pricing only. And that really shows you that for those of you who really want to take the cudgel here, that we're in a really good position, and we're all working in this together. I'm not at the arbiter of all knowledge, but I do have the luck and the blessings to have come through a fairly strong background of drafting. So I've drafted 4 SMSF deeds now, countless unit trust and family trust deeds. So I think the biggest deed I ever drafted was around about, 300 pages long, and that was for a quite a sizable unit trust. I've drafted up a lot of also defined benefit funds. In fact, if those who turn up to the ESOP tomorrow, you'll start to see a very unique blend for that. I think the ESOP side is extremely important for your clients. It's a great wealth creator, gives them a succession plan, but more importantly, from their client's perspective, is they can access, they'll start making monies from day one, their employees through employee unit distributions, which I think is super exciting compared to, for example, super, where it's locked up, which is one of the mainstays. So when we start doing that, that's where the high income and fees are coming in, and you'll start at a certain level, and obviously that will grow up as well. This is, you obviously heard a lot about the moat and the castle, and we'll keep on doing this. And we want to make sure that there's nothing out on those green fields, except obviously stuff we don't want. So we can actually be, and you'll see when we go through the protector, we could be sitting outside there, but still have all our assets protected, which is important. So when we build this moat, there's a whole lot of stuff going on. You've heard me around the protection side, protecting for death, family provisions claims, litigation, also bankruptcy and family law as well. For those of you who are on the Deed Awareness Week last week, we had some great sessions with Tim, and more importantly, went through some great stuff with both family lawyers and also insolvency practitioners, so that really the services that we can offer to our clients are very unique. They have been tested in court. They're tested, in fact, on a regular basis in negotiations between insolvency practitioners and their clients and their accountants. So the insolvency practitioner we had on last week basically said, look, if you get 2 years out, effectively, even though you've given a gift, so it's essentially a less than market value transfer, which is the normal 4-year rule. Once you get past 2 years, they tend not to worry about it. It's just too tough, which is fantastic for us, because it's not going to work for someone who's insolvent now or about to go into insolvency. But if your clients have got a fresh book, absolutely. So we're going to go through that. Estate planning, again, we want to make sure we keep everything away from family provisions. I deal on a number of instances through Abbott-Family with our advisors, and I'll show you the process that we work on that a little bit later on, because I think that's fairly instructive for a lot of you, because many of you have concerns about where that line stands between what you can do, what you can't do. So I want to show you how that in terms of that line, you can actually make a choice around that line, but still make quite a sizable revenue impact for yourself. So we'll have a look at that. I think that's pretty instructive. So from that estate planning, if we've kept I'm building some new testamentary trusts, and essentially the testamentary trusts that we're building will be inserted into the will itself. So it'll end up being an extremely bulky document, and the trusts we've got now are I believe they're a lot better than ones I've seen out in the marketplace. At the same time, we'll be building living trusts, which are based on that family protection trust, which enables us, if all our wealth is shifted in that family protection trust, looking after mum and dad at first instance, and then when it passes down to the children, that effectively there'll be sub-trusts or sub-funds built for each of those families within that trust. For those of you who hopefully have got the gist by now that we're dealing with trusts as make the jurisdiction South Australia in that essence, then obviously there's no rule against perpetuities. So it's very innovating, the stuff we're going. We'll be going into a lot more detail, going through clause by clause in terms of each of the documents around that. On that 3-day course. So I'm really looking forward to that. And it does make a huge difference. For those of you who turned to the trust distribution resolutions yesterday, you can see the family trust that we've built essentially is wide open. It allows, income as anything that the trustee determines it to be, whether it's accounting, taxable income, etc. and it can all be split into different categories. In fact, you can go right down and say this is a cash flow bonus, or this is this, or this is that. Obviously, dividends, capital gains, foreign tax credits, or foreign income, they can all be streamed quite specifically. So it's covered all in there, and you want that flexibility, but that security as well. I was looking at a deed this morning, which was a reckon deed, I think, but I'm not quite sure. But I had a look at this deed, and unfortunately, the income definition went straight to net income. Distributions could only be net income. So if you've got any accounting income over your net income, it just can't be distributed out of that trust, which isn't a bad thing, but it just means that it has to be held for corpus because it can't go out as income. So you can transfer it out as corpus, but again, it's preferable to have that more flexibility in terms of income, because the last thing I don't think many of you have probably done corpus trust distribution resolutions. So that's fairly important. So the estate planning, we want to try and keep as much as we can out of the estate. Really, when you have a look at it, the estate planning itself, that's good, fantastic. Thanks for that, John. Again, innovation is fantastic. I think this disruption that we are going through is pretty important. As I said, it's one of the major concerns that I know many of you have, and I'll talk about the Abbott-Family line up a little bit later on, but one of the ones there is many of you concerned about wills and estate planning. My belief is that if we've done our thing right, that there won't be anything left in the estate. And I've seen that happen quite a bit, because only one of our advisors came back the other day and said, look, I've been to the lawyer and he's saying that, is the estate planning right, because everything is stuck in the family protection trust. And that's exactly right. You only just need a basic will if there's nothing more than that. Obviously, you want to make sure we've got tax reductions, and the emphasis there is on bloodline, which is pretty important. From that one, it was just basically, it was only net income under Section 95 of the Income Tax Assessment Act. So you couldn't, if your net profit, John, was greater than your net income, you couldn't transfer the remainder out. Whereas obviously in our deeds you can. So that's again, you just got to be really careful. You can tell whether you've got a good trust deed. The first thing I always do is go to income and then look for categories of income. So you can do a bit of a search on that one. Bloodline legacy, obviously that is probably paramount, that if we're building these long-term solutions, we want to have a good bloodline legacy. So let's go through and have a look at in terms of property, but mainly because that's that essentially is the major wealth for a lot of Australians. Although we've got a lot of our clients in super, a lot of the SMSFs have got commercial property, farming property, residential property in them. We're still lucky to have obviously the borrowing rules in there as well. So I want to have a look at investment property first, and I'll go through that. Then I want to have a look at the family home and talk about some of the things we've been doing on that one. And then I want to have a look at property development and joint ventures for each of those. Then I want to show you the essential protector. And then we're going to have a look at, I want to show you Protector 2 in terms of trading companies and trading entities. So we're starting to clean up all of our clients' structures. Importantly, many of us, we've put in place these structures and really they don't do what we expected them to do. So again, that's not a bad thing, because again, if you come through the course, you'll instantly be able to go to a client trustee and or a new client coming in, or have a look through their trust deed and show where the weaknesses are. Honestly, it takes no more than 3 or 4 minutes to rip through a deed and find out the problems there and what quality of deed you've got. It's the same way in an SMSF. I can always, there's about 3 or 4 different aspects I can have a look at an SMSF deed to see whether it is really up to scratch or not. If we have a look at investment property, look, if it's in the personal names, which is traditional, I think the main one there is that tax incentives and the idea of negative gearing has been pushed for, God, ever since Noah was a boy, I think, in Australia, and that has really helped a lot of people in the pre-1985 days. You'd get obviously you get a tax deduction for your interest component, and then there was no capital gains tax. We then went to obviously the cost-based methodology, and only real gains were brought to account for tax, which would be no good in this current environment where you've got no inflation. But essentially now we've got, obviously since the changes to CGT, we've got now 50% discount for most personal. So it's still a fantastic deal for couples. However, over time, it does go cash flow positive. And I've seen a number of people, I'm sure you guys have as well, who might have 2, 3 or 4. We just dealt with one client who had 12 properties in their own name. Can you believe? We put it over the protector, but essentially that cash flow positive issue was a very tough thing. So we've just got to be really careful around that side of things. So when we have a look at it, great for tax incentives, negative gearing, but what we need to do is need to show our clients it's extremely exposed for litigation. Family law obviously gets thrown in as matrimonial property, can't stop it. Insolvency is a particularly big issue because we've got that house sitting there, and more importantly, if someone takes an action, well, if someone sees that it's sitting in our own name, then effectively it's like a red rag to a bull. And of course, family provisions claims as well. If that's left in our estate, then all manner of ne'er-do-wells, whether it's our children, grandchildren, ex-spouses, will all jump in there. If you do have that, ideally, irrespective of what we're going to do with it, because we're going to use the protector for it, make sure that you have, if it's couples, you do a related party partnership. It's not on our site yet, but it will be coming once we get to LYD2. We haven't been releasing huge amounts of documents up on the site, mainly because it doesn't make sense to put it up on our hot doc site and then move over to our brand new one in the next 2 to 3 months. So we're building those templates within LYD2. So that's a bit better. Trusts, well, trusts are great. We all know about trusts. Unfortunately, most of the ones that are set up, we find that they're pretty well exposed. So you've got directors of a corporate trustee. You might have one of them who are the risky partners, who are also the appointors, so they're controlling the trust. You also find they're a beneficiary, and notwithstanding that, the shares of the corporate trustee are held in the name of the person who's at risk. So if they get litigated, if they die, then the whole thing can collapse. I was involved in a case whereby there was a claim from children from the first marriage to get the spouse from the second marriage. There was a lot of property, I mean, believe this or not, but there was a lot of property sitting inside a self-managed super fund. There was also property sitting inside a discretionary trust. Both of them had trustee companies. So everything looked pretty tickety-boo in terms of the status of protection, except what happened was that the executor was pretty weak at the knees, and obviously a good no-win, no-fee lawyer came in and really started ripping into the executor, put an injunction over any move in terms of the transfer of those shares. So they were in the name of the executor. So the executor was forced not to do anything in terms of the corporate trustee. Unfortunately, the only appointor of the family trust was the deceased. And that case took 2.5 to 3 years to get to settlement. And look, that's not untoward. Many of you have been involved in exactly the same sort of cases. Whereas if they'd had a leading member trust, it just wouldn't have been an issue at all, because the shares would have been cancelled, gone down to the next person. That includes both the SMSF and also the trust. So again, the structure we've got, and I just talked about the concept of income. we really need to get on board a consistent trustee that we know. Get your trust distribution minutes aligned with that. And if you're using ours, it's aligned. Then you'll find with our system, it's easier to then generate it each and every year simply by changing the date. And it depends on what that trust has done anyway. The same thing with the SMSF. You can go down that track and use the leading member SMSF. Even go be so bold as to only have a single director corporate trustee, even though there might be a multi-member fund, provided we've got enduring powers of attorney for each and every person. And let's go down the investment property family protection trust. Look, we've built it. There's still a lot of work to be done on it. You might not think so, but as I said, I've got to build out that next level. It's like, for example, when self-managed super funds first were in vogue way back in 1994, pensions were virtually unheard of inside SMSFs. Everyone was madly accumulating. Whereas now we've gone past pensions and we're now into that estate planning side of things. And a lot of people are getting particularly squeamish around that. It's funny, a lot of the SMSF lawyers have got really no idea what they're talking about. Not what they're talking about, they just don't know the high level scheme of things. For example, traditionally, there's no way I'd ever be passing money from an SMSF if it's going to an adult child into an estate because of family provisions claims. I'd be building a special purpose testamentary trust that's created by the trustee of the SMSF. So it doesn't go in the estate, so it's not caught up with the family provisions claims. So we're building that out, but better still is this family protection trust. And I'd really love your feedback as well. I have to trademark one of the names, and I'm not sure. I'm going to send a survey out, but it'd be worthwhile for those of you who are on, if you just want to jump on and give me your views, and I'll look at it a bit later on. But do we continue to call these family protection trusts, or we call them leading member trusts? I don't want to go and trademark both, but I certainly want to trademark one of them. So if we have a look at it from that perspective, we're going to be in a pretty good position with that family protection trust. And so that's I think that's going to be a really good opportunity there for us. And again, we know about the longevity, the bloodline, tax profiles, and as I said, we're starting off with mum and dad at the top, but then what we're going to do is we're going to start to move down to the next generation, the generation after that. So we now start to need to bifurcate or trifurcate and start to build sub-funds in that. So that's where my focus is at the moment, is getting that right. And certainly I'll have a draft version ready to go by the conference. And I think it's important that, again, if I take you up here, where we go, oh, sorry about that. If I take you there, what we're doing, just have to let me go. What we're doing for that is essentially we're right down to that innovation level. So I need your help innovating, and a lot of you have been sorry, I had some tooth work done yesterday. So I need a lot of your help in terms of that innovation. And we had a really good session on Monday with 3 or 4 of our advisors who had a lot of suggestions around estate planning, so that we could work through those in a session, and then everyone could give their feedback. I've got one coming up for unit trust probably in the next week or 2. But certainly around the testamentary and family protection trust, we'll be looking at that in detail when it comes around to that course. And so we'll have everything to be laid out there. Will that be the end of it? Absolutely not, because things change, laws change. But more importantly, a lot of the stuff, and I think you're going to be surprised for those people who go on that course, and when we go down the track, there's not a huge amount of law in this area. For example, family provisions claim, there's a lot around it, but it's more very subjective, and it's more a thing of worrying about it, so that it's certainly not as detailed as SMSFs. In the course, I'll probably spend a good 4 or 5 hours on SMSFs, but that's where the real detail is. So we'll be having a look at that. Let me just check the chat. Family protection trust. Okay, I think, okay, good. Yeah, I agree with that one. So I think it's that was my feeling. We started with that leading member, but I think the family protection is something. Of course, I have to put the caveat there. We can actually get it, but I'm pretty sure we should be able to do that. But you never know with the intellectual, was the Australian Intellectual Property Association, whatever. SMSF from investment property, great asset protection. Once it's in there, you can't take it as a, if you take it as a lump sum, even if you're bankrupt, obviously you've got to shift it because you can't be a bankrupt trustee. It's great asset protection, can't beat the tax concessions at all, particularly if you're moving from accumulation to obviously the pension side of the equation. I'm doing one at the moment, which I've done in the past for a good friend of mine, Joe Walsh, down in Gold Coast. Another one's popped up where there's business real property, could be a farm, could be an office or whatever, is shifted over into a self-managed super fund, either using the CGT small business concessions, alternatively a related party loan. Goes into the fund. You don't need to do a normal contract you do a contract for sale, but not the typical one with a waiting period. It just goes straight in. As a consequence of that, you then register it, do a conveyance that goes in. You've done your investment strategy, set up a pension, and then lease it back to the relevant business or the entity that needs to use it. So that's been, again, a great strategy there, and that's easily a good $10,000 to $15,000 strategy there that we've been involved with. So SMSFs are great. Poor for family law. There are some strategies there for those people who, and I'll just give you a bit of a heads up. There's Mr. Munro. So hi, Tim, how are you? Good to see you there. For SMSFs, a couple of family law issues is make sure, I mean, you're using our SMSF anyway. If you're doing a leading member SMSF, then essentially what happens there is the leading member can boot the spouse out at any time. They just need to give 60 days notice. So if it's tied up in a property, that could be obviously problematical. But if you've got the cash, then obviously you can transfer them over to Australian Super or wherever. From that perspective, a couple of things is that getting them out is important. Once they go out, they've got no ability to access the accounts of the fund, the tax returns of the fund. All the opposing counsel, the lawyer, can do is ask for the members' balances. And as you're probably well aware, what the member's balance is probably not reflective of what the true underlying value of their balance should be. For example, if you have got property that's been going up in price and hasn't been revalued for a year or two, they could be quite significantly different, as could be also the other side of the equation that if we, for example, look at this current year from the 1st of July, or even for that matter, if we haven't done the accounts for 30 June 2020, we could take the earnings into an investment reserve, which doesn't sit in the member's account. So again, we can utilise some strategies there for family law, which are, again, they're all built within the SIS Act. So it's not as if we're breaching anything, we're actually abiding by the rules of the SIS Act. Negative gearing losses, not too bad. One of the problems obviously with the trust is getting losses built up into the trust. If you've got other forms of income, it's fine. Negative gearing losses, though, inside the SMSF are great because they recoup contributions tax. Those losses, because of the taxable contribution or deductible contribution, which we know as concessional contributions, go into the fund and are assessable. Just like any other income inside that fund, we can then take a deduction against it. And as a consequence of that, we're in a pretty good position of reducing our contributions tax. And that's the benefit of obviously having negative gearing losses. Ideally, it'd be great. And once it turns tax positive, obviously we can flick that over into the pension side. And if we haven't reached our transfer pension balance or anyone in that matter, we can segregate the assets quite specifically. So there's a lot there. The only problem about SMSFs is, again, not being in a position of accessing our monies until age 60. I just want to reiterate again, because I met a couple of people just recently who seem to have forgotten that at age 60, it's really important that you or your clients give up one form of gainful employment at that point in time. So I remember for myself at age 60, in fact, that worked out quite well. I'd left Now Infinity, and as a consequence of that, all my super turned unrestricted, non-preserved, notwithstanding I kept on working. So I've been able to utilise that and obviously lived on just my super for a while. Obviously, there's limits on contributions and we can get related party loans, but because the marketplace these days, if you have a look at La Trobe and some of the others, you can get them up to 80% in terms of their commercial lending, that we don't necessarily need to utilise the Commissioner's a related party ruling, where we can use that and put in place that whole process, but we can use T's and C's that come out of a very favourable commercial lender. So that's good. So that's where we are with investment property. My preference obviously would be SMSFs, Family Protection Trust. If you want, you could actually utilise both of them. So you can do a joint venture between the Family Protection Trust and the SMSF. You'll find the simple partnership agreement that's sitting on our site is a great little joint venture vehicle between the two. And you can pass further elements over a period of time from the Family Protection Trust. Alternatively, if you don't need a gearing, so there's no borrowing on it, and it's sitting in an existing trust or whatever, you can unitise it through a 1322C trust. But you just got to be very careful, particularly if you're looking at trying to get some of the exemptions available, say New South Wales or Western Australia, Victoria, or South Australia as well. Now, when we come around to the family home, there's completely different deals. Same thing. I think if I had, if I had to have a look at something that is really good bread and butter, will really make a difference to your practice over the next 10 to 15 years, it's going to be the protector and effectively protecting our housing prices or our equity you have in our houses. You can see in Australia, there's huge amounts of equity have gone in. As I said, there's been amazing prices are going out. But again, if it's in our own names, exposed for litigation, family law, insolvency, and family provisions claims, most people probably aren't, really aware of it. That hasn't been brought to their attention. So have a look at obviously the material for those who change GPS. Tim's done some fantastic work there. If you're not on Change GPS, we've got letters you can go out on that protector, and I'll talk about that a little bit later on. If you're keen at some point in time, certainly when we do the course in July, I'm going to actually take you through a 40-minute presentation that I do with clients around all of this. And to be truthful, I've never had a knockback yet. And that's for quite sizable fees. I just find it's a lot easier doing a presentation to the clients rather than just talk about it ephemerally. So we can do the presentation, follow it up with, say, the Change GPS letter, and then costs for that over a period of time. So again, getting your family home, great to have. Exposed for litigation, family law, so you get 100% CGT exemption. But look, it's just, anyway, my thoughts. Obviously, I still want to go, and I think you all know where we're going with this one, that the protector leaves the assets in the name of the individuals, so you still get the tax profiles for them, but the actual underlying net equity is transferred over into the Family Protection Trust. So that seems to be a pretty good idea. So with the trust, again, we've got the same problem. I don't see many homes inside family trusts, mainly because of the PPR exemption. However, I have built a product, and I went down, I'll just tell you about this. So I worked with a client down the Gold Coast, Leshan down there, so I'm not sure whether she's on the call or not. But if you are, we started going down the track of building a product. So in fact, I built a family protection trust, which could hold the principal place of residence, and then there was a long-term lease for that. That long-term lease was 50 years. It was only peppercorn rent. As a consequence of that, there was also quite a high surrender value, certainly in the first few years. That surrender value, so let's say the house is worth $1 million, 50-year lease, if we sold it within the first 2 or 3 years, in fact, it's probably even worth maybe even a little bit more than $1 million. Who knows for that one? But essentially that surrender value is treated as a CGT exempt. So there's private binding rulings on that one. And so everything was built around those private binding rulings. But I got halfway down the track and I thought, oh my God, so the problem is it's all very well, but if we've got that value in that surrender component, which is what we want, because that's essentially where the capital we want, and we can use that exemption. So it's great for asset protection, but then the surrender value, we need to determine that, and then that needs to be done under gift loan back. So we still need to go rip it through the protector, if that makes sense. And it's not a bad value, because when we rip it through in terms of the gift over, what will happen there is that's probably generally going to be almost the maximum surrender value, because it should depreciate over the life of that asset. But we have built that, and I'll probably launch that later on this year once we get LYD2. But I think that's an exciting one. If you've got any clients you want to have a look at that in a little bit more detail, just let me know on that one, and we can build it at Abbott-Family for you. SMSFs, you virtually, if it's a farm or it's any primary production, so if you've been lodging primary production returns, then any farm can be transferred into the self-managed superannuation fund. Obviously, you have to pay market value rent for living there. Commissioner's got ruling on bed and breakfasts, and likewise also motels as well. So you can have a manager's residence, you can have a bed and breakfast. I've argued in the past, and haven't got a ruling yet, but happy to go and try for a private binding ruling where someone's got strata management rights, where that'll be the case. Airbnb, no, I don't think that that's going to be the case, unless if you had 5 or 6 Airbnbs and a business plan, they're going to be business real property, but there's still that personal nature that essentially you wouldn't be able to live in them. So now let's go through property development, where to put it. Personal names, don't. The only thing you'll ever get out of putting in your own personal name is probably a potentially bad credit rating. Property development, it always goes swings and roundabouts. I've seen a number of rises and crashes. If you remember back to the Wall Street crash back in '87, everyone shifted to property. Property prices went up. 92 came around. We went into a recession because of high interest rates, and then property thereby collapsed after that. Likewise, not to a greater extent, but in 2000, when the tech wreck, 2001, 2002, property prices went up as well, and then interest rates went up, and then they shifted down. 2008, 2009, probably on the swing up around about 2005, 2006. There's a lot of off-the-plan developments. I know a lot of people made a lot of money on them, but also if you have a look at all the people that almost lost their farms from investing in, the Oracle down Broadbeach, or the Hilton down Broadbeach, or all across Australia. So likewise, the actual property market here, without long-term immigration, and certainly our baby birth rate is quite low, that over time that it's going to be interesting to see. The property prices are probably unsustainable, but they're just pumping so much money into the market. We've got virtually negative interest rates. What is it, 0.2% or 0.25%? That everyone's just plunging everything into property. So property, and the reverse on that is that obviously when that happens, all the property developers sniff up, get themselves out. But property development just can't be done overnight. So it's not like buying shares. You've got to find a site. So sites are pretty overvalued at the moment. Then you've got to get council approval. You've got to do everything else. Got to get your MES finance. You have to build the whole thing, and it can take 2, 3, 4 years. We're not too bad in Australia because obviously we can sell off the plan, but obviously that exposes the end people. If they go bankrupt, maybe we should do that and also set them up as a protector as well. But anyway, there's huge tax issues and you just don't want to get involved. So generally, we can do it through, in fact, all of this stuff I haven't even put in there. You can do it through a company, which isn't too bad, a trading company. I'm going to look at that very shortly. With a trust, again, it's not too bad, particularly if you've got a bucket company and a corporate trustee. If you are in the business of property development, you won't get the capital gains tax discount. It's just going to come out as a straight business income, but you do have some modicum of protection. You may well be involved with other parties, so therefore you'd use a joint venture, whether it's a SMSF and a hybrid or discretionary trust or a company dealing with that. So JVs, there's nothing wrong with JVs. We've done quite a lot of them at Abbott-Family lawyers, and there's plenty of commissioner rulings on it. So if you've got a big ticket item for property developers, just let us know. Just be really careful because they're good, but it's all cyclical. So there's swings and roundabouts. Keep it away from the family protection trust because just what it says is if you put that sort of stuff in there, it blows up. What sort of family protection advisor are you? SMSF works well. Again, if you do it, the issue is obviously in terms of the borrowing. You can develop property inside the fund. Obviously, you need the monies. Just have to watch out for the so you can, for example, get a property in there. You can knock it down and replace it. So home for home, apartment for apartment. Put in a new kitchen. Put in a new bathroom. All of that has to be funded directly from the superannuation fund. Alternatively, you can do a joint venture with a vehicle outside, such as a family trust, who can then borrow the money, then put it into the joint venture. You just have to be very careful about the agreements, but we've drafted a number of those ones. So I like SMSFs. It's a little bit on that edgier side, but provided you can get away with not having a charge on any assets of the SMSFs, because again, it's fully protected against your trustee in bankruptcy, then you're going to be A-OK. The borrowings, that's exactly the reason why you've got LRBA's limited recourse borrowing arrangements, because no creditor has recourse against assets in the super fund. So property development, probably I would suck out the equity and put it in the family protection trust. But use SMSF and maybe a company or a suit or a unit trust. If you're going to do a proper one that is going to be a large development, you need further capital, then probably use the unit trust, etc. I won't go through this in any great detail. Most of you guys know this is the protector. A lot of people still are getting a bit confused around the transfer of assets. There is no transfer of assets, essentially working out the net equity here. We then do a promissory note over by way of a gift. So a promissory note is equivalent to cash. We've set up the family protection trust with the family protection trustee company. Beneficiaries of bloodline, and as I said, we're going to start to bring that down into sub-funds. We need to have a really good succession plan, so it goes from one person to the next. So if we have a look at, I don't even mind having the risk person as the appointor, the family protection appointor, then their spouse and maybe one of their children, and then beyond that as well. So try to get 4 lines. The important thing about that is that you effectively, if you have a look at there, I know a lot of people like doing joint. I prefer to go down that way so that, for example, if the first in this one, say Tommy gets attacked, he just simply peels out of there, moves out of there, and it goes to Anna, his wife, and then Will, his son. If Anna's not around, they're going through a separation, then it just jumps straight down to Will. So it has a whole lot of combined impacts there. But it's so elegant in that it just goes from one to the next to the next. So that you'll see when we do our course that most of your planning should really be around that succession. Because once you get that succession plan, that fits into your powers of attorney, it fits into your executorship, it fits into your appointorship in the family protection trust, it fits into that leading member in the SMSF. So that when you're doing your moat and castle, it's so easy because you're just replicating the same thing over and over again. And so in your client's mind, it is all about that succession. And I know a lot of people, when I talk about succession, they say, oh, what about, is this business succession? No, this is long-term family bloodline succession. So we're leaving a legacy here. So we work out our net equity. That's where you guys get involved. For the planners, it's not too bad if you're using someone like My Prosperity. I know guys like Holton Baker down in Melbourne, they've got all the valuations of all their clients' assets, so it can be done at a drop of a button. We switch it over. Most of you hopefully have done one or two, or there's plenty of other videos on it. So we switch it over, and then we've got a promissory note going over, which is equivalent to cash. That's a gift that goes in the Family Protection Trust as a current asset. That's virtually just like equity. It's been an equity injection, but there is no transfer of assets. So, from that perspective, it's gone over. We've still got the same tax profile. So the client still owns the principal place of residence. So when they sell it, effectively what will happen, because what happens is there's that cash comes back out by way of a loan back to the client. And that's the way it's done. It's called an endorsement. It's just a transfer of the promissory note back. So the promissory note gets extinguished, but it's replaced by a loan. So the client will still have their principal place of residence exemption, but the settlement proceeds, effectively, what will happen there is they'll go into the Family Protection Trust, or they can be utilised because there has to be a repayment of the loan, or the client takes those monies and looks for another property, and then what we do is reinvigorate the loan. So it may well be the case that the existing loan's okay, but we need to register another mortgage, if that makes sense. So again, we still keep that principal place of residence. Likewise with investment properties, we've still got those tax profiles in that regard. So if we have a look at the tax profiles, we've got a situation that those tax profiles still enable negative gearing, but effectively for us, the net equity is sitting over. One of the other ones that I put in there, and you'll see on the next slide, is we have now got an option agreement. So, for example, if the home is worth 1.6 million, there's a $600,000 loan, so the net value is 1. The Family Protection Trust, what happens is the owner of the property, which is the individual concerned, let's say it's Tommy here, Tommy and Anna, they issue an option to the trustee of the Family Protection Trust to acquire that property for 1.6 million. So it's not the net value, it's actually the $1.6 million. Family Protection Trust will pay a premium, which will be a capital gain to Tommy and Anna. Now you want to do that at market value. So if you're buying it for 1.6, that's a current value, then you just need to pay $100 for the premium that's at market value. Beauty about that is then all the upside. So what will happen is in their names, the property's worth 1.6, but if it goes up to 2, then it means the call option sitting in the Family Protection Trust is worth $400,000. If it goes negative, obviously it's not worth that 400,000. Obviously it drops down, you lose your premium, etc. if the market tanks. But it means we've got the upside, so we don't have to keep on doing this gift and loan back all the time. The other beauty about it is because it's not an undervalued transaction under Section 120. For those who were on that session last week, undervalued transactions, obviously where there's been a transfer, here we've got a gift of cash over. So if we have a look at that, is that undervalued? It's hard to say really, because there's obviously been cash, and obviously it's a gift. So as it goes over, we've got that 4-year rule, but remember we talked about the 2-year rule. But that call option, the increase in the underlying value in it, that's been paid at full market value. So that's a true market value consideration. So obviously that's a further protection, which is really good. We'll go on. I've just got a couple of questions here. Would you recommend the protector for clients operating under a company or a trust does not hold any personal wealth? Perfect. So that's a great segue into the next sessions. John, early reference to PNs for SMSFs, whether it be temporary only 30 days. real property passing through the protector, how long could a PN remain unendorsed? What I prefer, I mean, there's nothing. In fact, if you go back, the actual act, believe it or not, John, and it's always good to have you on board, and you guys are very clever, that it goes back to the Bills of Exchange Act in 1909. And there's a section in there, promissory notes. So there is no limit on what you can do. From my perspective, it's probably not a bad idea. You can do it on demand because it's going to get endorsed back straight away in order to fund that loan. So that's a pretty important one as well. Let's move to the next one. So for this one, so what I've got here is the trading company. So this is our risky trading company or trading trust. The same way that what we're going to do is give the equity. So we're not going to give the equity of the assets. If there's underlying assets, such as, for example, logos, marketing processes, I dealt with one the other day, which was a large truck. They can be switched over or transferred over to the FPA or Family Protection Trust. So if you transfer it over, we generally use our CGT exemption. So you just got to watch your stamp duty and your CGT. So we can transfer that over, and then that would be leased back to the trading company. The purpose of that then sucks income out of that trading company in there. The question is, do we do a day-to-day lease, or so is it more of a rental hire, so the income is higher, or is it going to be more like a CHP? I'd probably go, depending if it was a truck or something, I'd go down the rental. So that would clean up the assets in there, transfer them over. The underlying shares that are in the client's name, I'd be gifting those over. So work out your valuation there. With the shares, again, you don't want to transfer it over if it's a CGT. This also applies not only to the trading company, but also the bucket company. So work out your valuation on that and then gift that over to the Family Protection Trust. So again, same sort of thing, call options and shares. So this should be the house is worth $750, and we transfer that out. So we bypass the SMSF. We've got all our assets there. We've got that red line. So at the end of the day, nothing is sitting on the side of the red line. It's all over this side where I can control it. It's protected from family provisions claims, litigation claims, trustee and bankruptcy. As I said last week, for most of our clients, the only way that they're going to go bankrupt generally is going to be through litigation. So from that perspective, the good thing about the Australian system is litigation takes a long time to progress through the courts. So that if they're in a solid financial state now, they go through this, even if in 3 or 4 months they got litigated and, ASICs come in or ATOs come in or whatever, by the time it gets through all the courts and then there's a judgment and then they have to do credit petition for the judgment, from that perspective, we're going to be at least 2 to 3 years or possibly 4 years down the track. So these are going to do really well. And as I said, the insolvency practitioner we dealt with last, sorry, let me just let these dogs out. The insolvency practitioner that we dealt with last week said, 2 years out, you're in a pretty good position anyway. So that's how we deal with trading companies. Trading trusts, again, strip all the stuff out. So all it's done is it's more like a shell. So that's a complete restructure. We will be putting that into the MOAT and Castle as well. So, but you can see it's still got the same thematic, but what we're doing is we're deleting the stuff on the right-hand side and moving it over. Again, I think most of you are pretty well aware of what's going on from that perspective. And of course, we need to do PPSR over the shares, do a registered mortgage over the house. You've got to secure it. Another one actually is worthwhile also looking at is in terms of existing, if this was a trading trust, if you've got UPEs in there, gift those UPEs over to that Family Protection Trust. I'd in fact turn them into a loan agreement. So once it goes over to the FPA, convert that UPE into a loan agreement between the FPA and the trading trust and secure it over any mortgage as well. Let's go down and, last one is I want to just go through that process. so I'm only going to be a couple of minutes. A couple of people asked some questions, so that sort of gives you a bit more of a deeper dive on how to deal with property. We'll look at a lot more case studies when we come around to the course. Again, we want to do a deep level dive on what the documents are, and I think that's crucial, because once you understand that, that will really take you along a way down the track. I will, for those of you who are registered in the course, I will be sending out a few cases for you to read, like a Taya Nosbaum, which is the case on the gift and loan back. We're going to be looking at, of course, Bamford case in the High Court, so we understand the difference between income and also net income, which I think is really crucial. And then what we want to do is, from that perspective, we want to start going through the unit trusts. We want to start going through our companies. We want to start going through SMSFs and also our family protection trust, and then start building that leading member, so that when you come out of there, you're going to have enough wherewithal to be, I believe, better than majority of lawyers around Australia in relation to that. Because most lawyers don't even prepare their own documents. Well, they prepare them, but from templates they've acquired off, obviously, it's either, it's, where do they get it? There's LexisNexis is generally the case. Alternatively, Thomson Reuters. Now, a couple of people, we've obviously gone through a lot of process and a lot of people working through Abbott-Family over the last year, and it's been interesting processes, and I personally hate that, and sorry if I've let anyone down. I hate it when things get caught up in legal firms. So what my preference is, because we're all starting to get busy and you guys are smart enough as it is, my preference for the most part, unless the clients are dealing directly with us, is this 5-step process if you want to use Abbott-Family. So if I just have a look on the left, we've got step 1, the client completes the data capture. We've got a new little book in town. It's called the Guide to Testamentary Trusts, which goes through a whole of testamentary trusts and goes through a great data capture. The good thing about that is that data capture, if they've got that down pat, it'll actually work really well. So it gets their mind in that estate planning. If we end up doing the protector, the same data that we've built in that testamentary trust, we can then utilise for our family protection trust for that next generation, those sub-funds. So it's a really perfect position there. So we use that with our clients. You get the data capture. Then what will happen is you'll then get that data capture, and generally most of you will be using the MOAT and the castle, and then you'll build that into light year docs, or it could just be the will with testamentary trust. From that perspective is you'll see with our new light year docs too, the data capture you'll be able to send out to the client in an online form. They'll complete it, but they're actually completing it inside the system. So that even takes it further away from, providing legal services, because really the client is creating that document. So where you want to sit, like if I was doing a deed of gift or a family protection trust or a company or an SMSF or just a straight pension, I'd stop there. So you don't need to work with us, because the documents have been signed off by Abbott-Family. You've done it, you've put it on. But there will be some big ticket clients you might need help on, or quite complex wills and testamentary trusts, notwithstanding the fact that we're telling them all about the protector. Or you just want to get a bit of mentoring to see what it's like when we go through it. So what will happen is you'll go through 1, you'll go through 2. Step 3, you send us the documents. Either Tony or myself will have a quick review, and then we'll come back and provide a quote. And the quote will be to go through the documents in detail. So we're just going to have a look at it summarily. Then what we do is, once we've given you the quote, we need to book at a time within a very short period of time to have a client Zoom. If you want to go through that step 3, it'd be worthwhile having a couple of times up your sleeve. In fact, once you send that through, we could do it the next day or the next 2 or 3 days if it's urgent. so that we then do a Zoom. I'll go through, or Tony will go through all the documents with the client, tell them what it's for. You know, there's like if we're doing the protector, we're setting up a family protection trust. Do you understand it's for bloodline? It does this, 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 and this. There's a deed of gift. The gift is going over. You don't transfer the assets. So we go through, and essentially I'll be going much the typical presentation that I'll be showing you at the course. Then once we do the client Zoom, go through the documents and educate the client, then what happens is we will then finalise the documents at Abbott-Family, send them back to you. So it's now on our letterhead off your PI. And then if you can arrange signing, you can get Tony to help with the signing process, but you've got a letter of advice around the execution of all the relevant documents. So you can go to your JP or anywhere else for that. Or alternatively, you can do a Zoom document. But I did notice that in terms of Queensland, they're about to shut down their, I think, digital witnessing from the 1st of July. I don't know why, or I do, because all the lawyers want everyone to go into their offices. But that's essentially the process there. You know, I'd like to get your feedback. I just send some feedback to us at Abbott-Family around that one, if you're not really on top of it. But I think that's the simplest process. The majority, 90% of all the documents on Abbott, on the Lightyear Docs site, you can do yourself. You don't need us. It's got the sign off. If you've got a big ticket client, or there's a family provisions claim, or they want a testamentary trust or sub-funds, get the first few done on us, and then essentially we'll go through there. So then you'll know exactly how we do it and how we deal with it. The good thing about this is you're still completing most of the documents, so there's good fees there in for you. Anyway, that's probably enough from me. Just a couple of things there. As I said, watch out for Lightyear Docs 2. I know Michael has already got, I think, over $800,000 in subscriptions, which is fantastic. So we're really in a good, strong position, cash flow positive. Have a chat to Michael if you want, Michael at lightyeardocs.com.au if you'd like to invest. But I know some of you were in there right at the start of us. Look, thank you very much for the support. But if there's ever time to invest, I would say it's now, because we've got some pretty good inflows coming in, but more importantly, we've got some really good sales strategies for the next year to go and attack that market. We've just been hanging back a little bit because we want to, you guys have seen what we've got. It's, as I said, a silk person from Sal's ear, but Lightyear Doc 2, we really want to go out with a big splash on that. But let's hope that we'll see you on the course. If not, tomorrow Michael is going to go through the employee share plans. I won't be on that session, but I've drafted up what I believe is an amazing employee share plans and a system there, so that I know, John, you've got a few there. And I think I'd love to have a chat with you about it, because I believe the stuff I've done is extremely revolutionary. It's a cross between the old Macquarie Bank bonus schemes for shares and some of the old vesting, defined benefit vesting schemes, so that the employer is still in control of that trust at all times, but it provides a lot of benefits for employees. But anyway, Mike will go through that tomorrow. Thank you very much for your time. Really appreciate it. You guys are going to get plenty of CPD out of this one. And hopefully we'll see you before 30 June. And if not, then have a great year. I know most of you are going to have some time off at 1st of July. So, enjoy yourself. I'll be working through because I've actually got to finish building this course, but I'll be giving you plenty of stuff to read if you're off in a nice warmer climate like up in Cairns. But anyway, it's great, Abbott. Signing off.